Free cash flow to the firm is that cash flow which is available to the company's supplier of capital, including bondholders, loan providers, preferred shareholders, and common shareholders, after meeting all the requirements of the business, including operating expenses, taxes, long-term and short-term growth requirements. Free cash flow to the firm can be used to pay interest and principal, dividend, buy back shares, acquire other companies, and finance expansions. Free cash flow to equity, on the other hand, represents cash flows that are only available to the company's common shareholders. It represents that cash flow that is free from interest or principal charges or preferred shareholders' preferred dividend, and it is only available for distribution or the use of the common shareholders of the company. Both free cash flow to the firm and free cash flow to equity are commonly used in discounted cash flow valuation. For example, to value the firm, the formula used in the constant growth version of the discounted cash flow model is value of the firm is equal to the free cash flow to the firm in the current year multiplied into 1 plus the growth rate in cash flows divided by the weighted average cost of capital of the company minus the growth rate of the firm. This gives us the value of the firm using the constant growth model. If we want to value the equity of the company only, in that case we will change the formula to reflect only the valuation of equity. In that case it will be free cash flow to equity in the current year into 1 plus the growth rate of the free cash flow to equity, and we divide it by the cost of equity minus the growth rate. So these are two versions of the discounted cash flow model. Of course, there is a zero growth version and there is a multi-growth version of the discounted cash flow valuation model for both valuation of the firm and valuation of the equity. To calculate the free cash flow to the firm, we start with net income and add back any non-cash charges, for example depreciation, amortization, and then we deduct from it working capital investment, that is any additional investment in working capital. So for example, if at the start of the year current assets minus current liabilities were equal to 200, and at the end of the year the current assets minus current liabilities, that is the closing working capital, is 250, it means there has been an investment of 50 in the working capital. So that additional investment in working capital will be deducted here. In case the opening working capital is more than the closing working capital, then that will be added here. The after-tax interest expense is added back to net income because interest expense is a tax-deductible expense. As a result, the net income has already benefited from lower taxes due to interest expense shielding taxes. As a result, we only add back the after-tax interest expense. We deduct from it the fixed capital investments also, which represents long-term investment or capital expenditure. We can write the formula like this: free cash flow to the firm is equal to net income plus non-cash charges plus interest expenses into 1 minus the tax rate minus fixed capital investment minus working capital investment. However, you will come across different formulas for free cash flows in the literature and online. To calculate the free cash flow to the firm, we can also use the operating cash flows from the cash flow statement. So we start with net income and we add back non-cash charges such as depreciation and amortization, and we deduct from it working capital investments. That gives us cash flow from operating activities, as we saw in our previous discussions. With this, we add the after-tax interest expenses and we deduct from it the fixed capital investment to get the free cash flow to the firm. So if you are having the cash flow from operating activities available from the cash flow statement of any company, you can just add back the after-tax interest expenses and deduct from it any fixed capital investments to arrive at the free cash flow to the firm. As free cash flow to the equity represent those cash flows that are available to the common shareholders of the company, we do not need to adjust for the after-tax interest expenses. However, we will be considering the net borrowing to calculate free cash flow to equity. So the first three entries in the formula remain the same. That is net income plus non-cash charges minus working capital investment. Again, these will be equal to the cash flow from operations in the cash flow statement. And from this we deduct fixed capital investments, and then we add back any net borrowing or deduct from it if there are any net payments. So for example, if the company has paid back $500 million in loan, so this is repaid, okay. However, the company obtained new loans worth 700 million. So there is a net debt issue of 200 million. So in that case, it will be added like shown here. However, if the company has paid back, let's suppose 800 million in old debt, okay, and has issued only 400 in new debt, in that case, it will show a minus here because the net debt repayment are more than the new debt issued. So it will be positive in this case, that is net new borrowing, and it will be negative in this case because net debt repayments are higher than any new debts issued. Positive free cash flow to equity implies that the company has excess operating cash flows over amounts needed for capital expenditures and repayment of debt. This would be available for distribution to shareholders. Before calculating any cash flow performance ratio, if the company is reporting under the IFRS and has included total dividends paid as an operating cash flow, this must be added back to the cash flow from operation as reported, and then the preferred dividends should be subtracted. From our earlier discussion, we know that cash flow from operations reported under US GAAP and IFRS may differ because of the treatment of interest and dividends received and paid under both the accounting standards. Cash flows based ratios provide information to the analyst that help him better understand the company's past performance and also develop expectation about the company's future prospects, particularly related to valuation of the firm and valuation of the equity of the firm. The cash flow from operation is considered as a proxy of cash income. The ratios here use cash flow from operations relative to another financial item, measure the cash return to the firm. For example, the cash flow to revenue measures the operating cash generated per dollar of revenue. Similarly, the cash return on asset is calculated as cash flow from operations divided by average total assets, and the cash return on equity is similarly cash flow from operation divided by average shareholders' equity. The cash flow per share is then calculated as cash flow from operations minus any preferred dividends divided by the number of shares outstanding. This gives us a measure of the operating cash flow on a per share basis. Keeping other things constant, the higher are these ratios, the better it is. That is, the higher is the cash return. In each case, the better it is. The cash flow coverage ratios measure the extent to which the operating cash flow cover the various commitments and expenditures of the firm. As with cash flow performance ratios, the higher is the cash flow coverage ratio, the better it is. For example, in the case of debt coverage ratio, the cash flow to debt is calculated as cash flow from operation divided by total debt, and it is a measure of the financial risk and financial leverage. So the more is the cash flow relative to the total debt, the better it is, because it means the company will be able to pay back its maturing debt obligations. The cash flow interest coverage ratio, on the other hand, is equal to cash flow from operations plus interest paid plus taxes paid divided by interest paid, and it reflects on the ability of the company to meet its interest obligations. The higher is this ratio, the better it is. Reinvestment ratio, on the other hand, is equal to cash flow from operations divided by cash paid for long-term assets. It is the ability of the company to acquire assets with operating cash flows. So the higher is this ratio, the higher is the ability of the company to acquire assets with operating cash flows. Same is the case with debt payment ratio. The higher is the debt payment ratio, the better is the company able to pay debts with operating cash flows. The cash flows to dividend paid or the dividend payment ratio measures the ability of the firm to pay dividends with operating cash flows. Again, the higher is this ratio, the better it is. Finally, the investing and financing ratio, that is the cash flow from operations divided by cash outflows for investing and financing activities, measures the ability of the company to acquire assets, pay its liabilities, and make distribution to owners, that is in the form of dividends, etc. Again, the higher is this ratio, the better it is, because the company will have ample cash available to meet its investing and financing cash requirements.